Hi, it's me again, Professor Keister, and we're going to continue our discussion about corporate and partnership taxation. We've discussed the three predominant types of business entities, and we've compared and contrasted the various attributes, particularly along the lines of personal liability and control. Now we're going to talk about tax law. Okay? Now, tax law is comprised of more than just statutory provisions as enacted by Congress, meaning to say the Internal Revenue Code. Tax law also includes executive agency law. Okay, we're talking about federal regulations, IRS pronounces. Tax law is also influenced by tax treaties that Congress ratifies. Tax law is also comprised of and influenced by the judiciary through its decisions, its interpretations, and its various legal concepts that it contributes to tax law. Now, there are several objectives that tax law seeks to achieve. This body that is comprised of codified law, federal regulations, Internal Revenue Service pronouncements, and judicial decisions and interpretations. There are certain things that the tax law seeks to achieve. First and foremost is the raising of revenues. Okay? The IRS will tell you that its principal duty is as protector or guardian of the national revenue. Okay, and that conjures up an image of this big burly policeman with biceps the size of Boston protecting this pile of gold. Yeah, well, in order to get that pile of gold, it has to accumulate it. It has to gather it. And that's the real job of the IRS, and the real job of the tax code is to acquire the revenues, the tax revenues that the federal government needs to operate, to keep up a standing army, to keep a fleet at sea, to pay for its social programs, to pay for Social Security and welfare, to give the homeless cell phones. That's the IRS's primary job, and that's the primary purpose of the tax code. Now, I'm going to diverge for a second. Another very important purpose of the Internal Revenue Service, I might add, which is a sub-agency of the Treasury, is to ensure for the efficient and equitable administration of the tax system. And that's very important, but it's not as important as raising revenues. Okay? So raising revenue is the big reason for the tax code. But the tax code also seeks to achieve certain economic objectives. For example, in a time when the economy is lagging, such as what we've been living through the last 5 or 6 years, the government may encourage the adoption or the implementation of additional deductions, tax credits, and exemptions that the average taxpayer may avail themselves of in order to reduce their tax burden. And the expectation is, the theory is, that any reduction in the tax burden is spent by the taxpayer. Okay, it either goes into the bank or it gets spent on a new washing machine, a new dryer, a new car, maybe a new house, but it gets spent. And what is at play here, or what's being subtly, the nuance here is that a dollar spent in the economy has more of effect than a dollar taxed. I think on average a taxed dollar, only about 40% of that dollar finds its way back into the economy, whereas almost 100% of a dollar spent in the economy goes into the economy. And even if it's not spent, If it goes into this savings account, you have a money multiplying effect where that money is lent back out to businesses that want to borrow money in order to expand and grow. So at the basis of all this is that money spent or any tax benefit achieved or derived from a reduced tax burden is somehow spent by the person who receives the benefit or the entity that receives the benefit. You either expand your production base, you buy a new piece of equipment, or you put it in the bank. But somehow that money finds its way back into the economy, and it finds its way back into the economy in a more efficient way than if the government had taxed it. Okay. By the same token, if the economy is expanding too quickly, and inflation is rising, then what the government can do is it can make some changes to the tax code or to federal regulations, and it can it temporarily place in abeyance certain tax breaks, certain tax credits or deductions, and result being now the taxpayer has fewer options to reduce their tax burden. They wind up paying more taxes, and that takes money out of the taxpayer's pocket, which means to say the taxpayer has less money to spend, and that slows the economy. Okay. The government also the government also uses the tax code to encourage certain activities. For example, the government realizes that the dependence on fossil fuel is a strategic vulnerability to the United States. So the government offers tax credits if people go out and buy hybrid cars or electric cars. Government realizes that the adoption or the development and adoption of new technologies are inherently beneficial to business. And so they encourage companies to engage in research and development. So those research and development expenses are directly deducted, which reduce the tax burden on a corporation. Organization costs. Again, the government realizes that a streamlined, efficiently organized corporation produces products and services at a lower cost and a more competitive cost. And so they want to encourage streamlined organizations to the extent that reorganization costs are deductible by a corporation. Equity. The tax code is also used to provide an element of equity to the tax-paying community. Now, equity should not be confused with fairness, because what is a fair tax policy to one taxpayer may be a manifestly unfair tax policy for another. But what we're talking about, there are certain things that all taxpayers are vulnerable to or subjected to that the tax code tries to mitigate. The effects of inflation, for example, the multiple taxation, the annual accounting period, and then of course in terms of equity, the tax code tries through the wherewithal to pay to provide a measure of equity, in the sense that if you didn't benefit from an exchange or a transaction, you shouldn't pay taxes on it. Now, let me go into the wherewithal to pay a little deeper. The wherewithal to pay concept basically holds that if an entity did not benefit materially from a transaction, or if the transaction did not provide the opportunity to pay taxes, then the entity shouldn't have to pay taxes on that transaction, on any gain that might have arose from or resulted from that transaction. Now, that does not mean that in the long run they don't pay taxes. What it means is any tax on the transaction, on the gain transaction, is deferred. So what am I talking about here? Okay, let's take a scenario where I have to think about a scenario here. Let's take a situation where I am a donut manufacturer and I deliver donuts in the mornings, and I've got a truck that's carrying a basis of $10,000. Now, for the sake of argument, we're going to say that the fair market value of all assets discussed just also happens to be the adjusted basis. An adjusted basis is another way of saying the book value. Okay. So I've got a truck worth $10,000 with an adjusted basis of $10,000, and I need a bigger truck because I'm expanding. And there's a guy across the city, and he's a carpet installer, and he's got a $15,000 basis vehicle, but he's looking to scale down operations because he's about ready to retire, and he's ready to let that truck go. And so I managed to talk him into an exchange. Okay. And that's called a Section 1031 like-kind exchange. Now, I give him my $10,000 basis truck. I get a $15,000 basis truck in return. In theory, I've got a $5,000 gain on that transaction. He's got a $5,000 loss on that transaction. The federal government, or the tax code, says, you know what, Mike? Your material circumstances weren't affected by that transaction. And you certainly didn't receive money. You certainly didn't receive cash that would allow you to pay taxes on any transaction. So you don't have to worry about paying taxes. Now, when you ultimately sell that truck, now you may have to pay taxes on that. So, ordinarily, the way things would work in a like-kind, Section 1031 like-kind exchange, where there is no boot, which means to say there isn't any additional emolument thrown in, additional property or cash, okay? It's just, you take this asset, you give me your asset, done deal. Where there is no asset, where there's no boot involved or additional property, what happens is the basis of the property you receive becomes the basis of the property you gave up. Okay, so I've got a $10,000 truck I've given up. I've gotten a $15,000 basis, but guess what? I'm going to change that basis to $10,000, and the other guy's going to do the same thing. He's going to change his $10,000 truck basis that he just received to the old basis of $15,000. Now, let's talk for a second. What's the likelihood of me finding someone who's going to give up a $15,000 book value asset for a $10,000 book value asset, assuming fair market values are the same as the asset's book values? Okay, pretty low. Okay, because I've got the lower book value, the lower fair market value asset, I'm probably going to have to throw something in to sweeten the deal. I'm going to have to throw in something called boot. Okay, now let's say, how much boot? Well, the rule of thumb is as little as possible. But let's say, for the sake of argument, I throw in $4,000 cash. Okay. Now, I'll show you this in a backdrop, a demonstration, what do you call it, a projection. There is a procedure for calculating realized value and recognized value, and the new adjusted basis of property received. What I want to talk about for a second here is every asset has a book value, which is what in taxation circles they call the adjusted basis, and a fair market value. And when I give up an asset and receive an asset in exchange, I'm giving up an asset with a book value of such and such and a fair market value of such and such. I'm receiving an asset with an adjusted basis or book value of such and such and a fair market value of such and such. I have to figure out the new adjusted basis on that new property that I received. Okay? In cases where there's no boot, the new adjusted basis of the property I received is going to be equal to the old adjusted basis of the property I gave up. But that's only when there's no boot. In the case that I'm postulating, I threw in $4,000 cash. So what I have to do, like I said, there's a calculation here. I take the fair market value of the property I received, which was $15,000. Okay. I subtract from that any boot that I received. Well, I didn't receive any. I subtract from that the adjusted basis of the property I gave up and any boot that I threw in. Well, that's $14,000. So I have a realized gain of $1,000, and that makes perfect sense. Okay? I gave up a truck with an adjusted basis and a fair market value of $10,000. I threw in $14,000. I received a truck with an adjusted basis and a fair market value of $15,000. Yeah, it makes perfect sense. I've got a realized gain of $1,000. But a realized gain is a theoretical gain. It's not necessarily recognized. And that's the difference. Recognized is what you got to pay taxes on. If you've got a recognized gain, you got to pay taxes on it. Realized, it's theoretical. Recognized, pay taxes. Do not pay pass go, pay taxes. Okay. So I've got a realized gain of $1,000. Now, next I have to calculate what's my recognized gain. And the rules are, and I don't know who came up with the rules, but the rules are, it's the lesser of my realized gain or boot received. Well, my realized gain was $1,000. My boot received was 0. So my recognized gain on this transaction is 0. All right, so I gave up a $10,000 vehicle, $4,000 in cash. I got a $15,000 vehicle in return. I've got a realized gain of 0. A recognized, meaning to say a taxable gain of 0. But what's the new adjusted basis of that new truck that I received? Well, according to the rules, it's the adjusted basis of what I gave up and any boot, $14,000. Okay, less any boot received. Well, I didn't receive any boot. Okay, plus my realized or my recognized gain. Well, my recognized gain was 0. That's $14,000. Okay, so my new adjusted basis is the equivalent of everything I gave up. I gave up a truck with an adjusted basis of $10,000. I gave up $4,000 in cash. That's $14,000. And guess what? The adjusted basis of the truck I received is going to be $14,000. Now, for the guy who gave up the $15,000 truck, things are different. We're going to follow the same procedures and the same rules, but you're going to come up with a different result. Okay? Well, okay. For the guy who gave up the $15,000 truck, he's going to look at the adjusted basis, the fair market value of the property he received. Well, that was a $10,000 truck that I gave, $10,000 truck that I gave up, and any boot that he received. Well, that's $4,000. Okay. Then he's going to subtract from that the adjusted basis of the property he gave up. Well, that's $15,000. So he's got $14,000. He's subtracting $15,000. That's a realized loss of $1,000. Now again, realized is theoretical. You pay taxes on recognized, not realized. Now, there is another rule you got to remember here as we move into determining the recognized gain. Remember when I said earlier, the recognized gain is the lesser of the realized gain or loss or boot received. Well, boot received in this case is $4,000. But when you're talking about a realized loss, which in this case is $1,000, you use 0, okay? Just one of the little things you got to remember. So, the recognized gain slash loss for the guy who gave up the $15,000 truck is 0. Now, he's got to figure out the adjusted basis of the truck that he's received. And that's going to be the adjusted basis of the property he gave up, $15,000, less any boot he received, which was $4,000, plus his recognized gain, which was 0. So you've got $15,000 minus $4,000 plus 0 is $11,000. So the adjusted basis of that $10,000 truck that I gave up to him in exchange for a $15,000 truck was $11,000. The adjusted basis of the truck that I received from him is now $14,000. What's going on here? It's the boot. It's the $4,000. Because I threw in boot, the adjusted basis rose of the asset that I received. It rose from $10,000 to $14,000. For him, the recipient, the $4,000 is deducted from what he gave up. So again, boot is a critical factor in determining the adjusted basis. Whatever boot you throw in, okay, you're going to add. Whatever boot you receive, you're going to subtract in calculating your adjusted basis. That's kind of an elaborate way of explaining the wherewithal to pay. And in all of this, what the government is saying is, well, it hasn't really changed your material circumstances, your economic circumstances any. You know, Mike, you've received a $15,000 truck, that hasn't changed anything. He's received a $10,000 truck, that hasn't changed anything. Your material circumstances haven't changed, so you shouldn't have to pay taxes on anything. Okay, so that's the reason for, or the objectives that the tax code seeks to achieve.